I had my first interview, as I mentioned, and after I told the man that I didn't really know anything, how could I start Monday? And he said, go buy this book. And he wrote down a book called A Random Walk Down Wall Street. There were no index funds in 1973. You know, the biggest problem in emerging markets is the index itself. Well, the only reason a company has value is because it makes profits. The other big problem in emerging markets is that most of the internet companies are not in the index.
When we are getting to see all of the things that's in the news right now, like, hey, China has got all of these issues with the United States. Of course, India is now as we are recording it, on the brink of what could perhaps be some sort of like a war with Pakistan.
The world's a risky place, and the riskiest place are the emerging markets. The definition of an emerging market is what MSCI says it is, but nobody's going to invest in third world countries. You need to change the name. And so they decided they would change the name and call them emerging markets. Almost everybody agrees that Korea's developed, except for MSCI. But when I launched 11 years ago, our main fund, EMQQ, it was 65% China and 1% India, because there was only 2 Indian internet companies. I've said to many people, I mean, India is the perfect emerging market.
A lot of people who look at India, they probably know 3 things. They know Slumdog Millionaire, they know Bollywood, they know cricket. India in general, if you take a look at it, and public market investors have largely been conservative investors.
Whether it's travel or food delivery or whatever, these subsectors can grow 300, 500%, and it will still be early. All of the emerging market internet companies had a correction. Amazon didn't make a profit for 20 years.
Right. Kevin, welcome to the Desi podcast.
Thanks for having me.
We don't typically have investors like you here on the show, but I'm really excited about this because it really opens up different avenues for us to discuss here on the podcast. And what I'm really excited about today's conversation is the evolution of the public market investing space and how emerging markets kind of like play a role in that. And you've obviously played a huge role in helping developing economies and companies that are emerging out of those markets to shine. So we'll get a little bit more deeper into that. But before we get into it, let me ask you this question. How do you get into public market investing?
Well, I didn't plan it necessarily, but I grew up here in the Bay Area, and I went to college at the University of Arizona, and I got a degree in economics, and then I moved home. And I wasn't totally sure what I wanted to do. I didn't know, maybe real estate, maybe the stock market. And it so happened I got an interview from a relative who knew somebody. And it was with a company called Robertson Stephens and Company, which was back in the 80s and 90s. It was really the leading investment bank in San Francisco, and it was the leading technology investment bank in the world, arguably. And so I showed up for my interview, and we talked about college sports for 30 minutes, and then the guy said, you can start Monday. And I said, well, I don't know anything. And he said, well, go buy this book. And I read that book, and I showed up on Monday morning. So I didn't really plan it, but right. I knew it was something I was interested in, but that's quite literally how it got started.
Maybe as a follow-up question to that, because a lot of our listeners will be exposed to this kind of content and information for the very first time. What is public market investing, if you were to like dumb it down to somebody who is trying to understand the space for the first time?
Sure. Well, it's stocks. It's investing in the stock market. I know that most of your guests are from the venture world, private world, but in a traditional sort of corporate development, you raise money from friends and family or some kind of an angel round. You raise venture money, and eventually, when you're depending on the market at the time and so forth, but you become big enough to go public, and you do an IPO, and then you're the public part of the public markets, and now that's you used to go public a lot earlier in the old days.
Yeah.
Now you've got companies that are 50, 100, 200 billion dollars that are still private. So it's evolved, but essentially, investing in the stock market is what I've focused on my whole career.
And where does, of course, with public markets, you have a wide range of investments to choose from. You can just be journalistic and invest across the spectrum, which is what most people try and do in terms of diversifying their investments, or you can just go deep into one particular segment. Perhaps defense is a good example, or just tech stocks are good examples of that. When you were getting started, to your initial knowledge information about where the investments were going into back in the day, to where the industry is today, and in terms of just how people have thought about diversification and portfolio management, what have you learned about how people and how they invest in the public market?
Well, I would say, importantly, when I had my first interview, as I mentioned, and after I told the man that I didn't really know anything, how could I start Monday? And he said, go buy this book. And he wrote down a book called A Random Walk Down Wall Street. Mm-hmm. And I went to the bookstore out by my home and bought the book, and I went home and read it over the weekend. And that book is, it's famous because the man that wrote it, who's named Burt Malkiel, he's a Princeton economist, he first wrote the book in 1973. And when he wrote that book, essentially he invented the index fund. There were no index funds in 1973, and in 3 paragraphs he laid out his case for, somebody should make a fund that just buys all the stocks, doesn't do trading, charges a low fee. And he suggested the New York Stock Exchange launch this index fund, but they didn't. His friend John Bogle did. So now when I started 20 years later, or I guess 30 years later, 20 years later, 1992, indexing was still very small. Right? There were no ETFs yet, and index funds were really a small thing. And I worked for an active mutual fund company, and at the time, that was really what most people invested in, were active mutual funds. And now, certainly the biggest, most consequential shift in that 30 years or so since then was that indexing is one. Index funds started to eat the traditional mutual fund assets. ETFs showed up, which initially was the S&P 500 ETF, which the author of A Random Walk also was involved with. He led the development of that. And so it's also been democratized, investing has, which is part of what I did in my early, when I was a fintech entrepreneur starting in 1999, which is developed fractional share brokerage. So you could buy $5 of a company. Because back even in the late 90s, if you wanted to invest in the stock market, the cheapest commission you could get was $29 for a trade. But you also had to buy 100 shares of a stock. Right. And the average stock was $30 a share. So you had to buy $3,000 of one stock to invest in the stock market. And, I was this very idealistic, young value investor, and I thought, well, why can't, and this was in 1998-9 when the internet had just been around for a couple of years, basically. And I thought, well, why can't we pool orders and let people buy $5 of a company or $10 of a stock? So since that period till now, there's been massive developments. The fractional shares really leveled the playing field, which we sold our business eInvesting to ETRADE in 2000, but now, fractional shares has gone mainstream. So, and of course, app-based, whether it's Acorns or Wealthfront, you can do a lot of things now that you couldn't have done back then. And so, in the U.S., it's democratized. It's been taken over by exchange-traded funds, which is really increasingly taking over the market. But in emerging markets like India, all of these things are still
nascent,
very nascent.
Yeah.
So, but it's it's good and exciting. Now, people, the bigger problem is using the tools the right way.
Yeah.
Not trading options, which became a huge problem in India.
Right.
But using the technology that's available to buy and hold things that are going to have good long-term performance in this. At least in the United States, there's almost an infinite variety of ways you can buy levered single stock ETFs with ETFs with options overlays. But in India, it's still very early. But it is great to see the Indian, the 100 million plus Indians using the strategic investment plans, rupee cost averaging. That's what you want to do.
Yeah.
But you don't want to be doing the options trading. I know that part of the Indian, the frothy Indian stock market that was tempered down a little bit, but the options trading was a pretty clear sign of excess enthusiasm amongst the Indian retail investor.
Yeah, no, these are some really interesting points you brought up in comparing how the markets evolved, obviously. And one point that you touched upon there was how, let's say, emerging markets like India, while the average investor is still very young, by young I mean the market is young, they're still learning about investing in different tools and different financial instruments. And the stock market is just one such that people have looked at. It's become a little bit more mainstream in the last few years. And I think a lot of that, you have to give a lot of credit to the startup ecosystem to have created that knowledge. It's not to say that investors in the public markets didn't exist in India. Of course they did. You have some of the biggest names in the industry, and people obviously spoken about them for the longest period of time. But in my opinion, what's really made it a little bit more mainstream and probably even cooler with younger generation is how the story and the arc of a company, of how a startup goes from, being born, as you previously mentioned. You give an example of raising friends and family rounds, VC funding, going public, and then trying to sustain and grow that shareholder value over years. Now, with that abundant information, with that abundant capital right now that India is sitting on, obviously it's a market that investors like you and others will find massive potential in. And I've heard you talk about, the India opportunity and why India is an emerging and exciting market. And we've heard and listened to all the numbers before. So I'm not going to make you repeat yourself. And obviously the numbers are there to be spoken. But with how fluctuating markets in these emerging countries are, and India is just one of those examples. You have countries in Southeast Asia, you have countries in Latin America. We were just talking about it before the recording. With how much markets fluctuate here and the markets still being in infancy, do you at some point not take a look at it and also feel like it's somewhat of a riskier investment? Of course, public markets are risky investment, but there's slightly more riskier investment to make rather than investing in markets that are perhaps on the up, but in markets that have already been proven out and been successful, like here in the United States or maybe in Europe?
Well, first of all, we invest in all emerging and frontier markets.
Of course.
So that's about 45 companies.
Yeah.
And there's really nothing homogenous about them. I mean, the risks in Brazil versus Russia, for example, which used to be the emerging market, now it's in the doghouse, if you will. China. So there's really nothing homogenous about them, and then there's also different risks in each country and different stages of market development, right? The internet, the Mercado Libres of Latin America, Nubank, they're a lot more advanced than the Indian ecosystem in some ways. So it's really kind of country by country, but ultimately, the biggest problem in emerging markets is the index itself. The MSCI Emerging Markets Index, which is what the vast majority of investors in public markets use, it's a mess. I mean, it's got two big problems. First, about 30% of the companies are state-owned enterprises, right? We're talking Chinese banks, the Chinese state-owned oil companies, Petrobras, the poster child for this in Brazil, and they're not trying to grow their earnings. And I'm an Omaha investor first and foremost, and in Omaha, investing is really simple. When I say Omaha, I mean Berkshire Hathaway, Charlie Munger, that kind of direction. It's really simple. The only reason a company has value is because it makes profits for the owners. Yeah. And the only way to grow the value is to grow the profits. And state-owned enterprises don't care about that. And that's 1/3 of the entire MSCI Emerging Markets Index. And they haven't in the last 10 years, the MSCI, its earnings have gone down.
Yeah. And
Its revenue has gone down.
It's the dollar test, right? That, quite famously Charlie Munger is obviously, and Warren Buffett have backed for the longest period of time. The best way to test if the company is going to make money is try and see where they put that $1 of money that they earn into.
Yes. And the other thing, the other big problem in emerging markets is that most of the internet companies are not in the index.
Right.
So Mercado Libre, the largest company in Latin America, the best performing stock in Latin America over the last 15 years, it's not in the MSCI index. So if you buy the iShares ETF or the Vanguard ETF, you're not buying the single best company in Latin America. What you are buying in Latin America is Petrobras and Petrobras Preferred.
Right.
So you get two, allocations to the corrupt state-owned oil company, but you have this incredible entrepreneurial powerhouse, Mercado Libre, that's not in the index. So this is if you're going to invest in the United States, yes, buy the S&P 500 or something essentially like it. Don't buy the Dow Jones. That's very old school. But in emerging markets, there's no S&P 500, right? Yeah. The MSCI index is not the S&P 500 of emerging markets. It's the largest companies. Doesn't matter if they're state-owned, and it's a real problem. But the internet is definitely the way to invest in all emerging markets, I think.
And you said, the two biggest hurdles or two biggest risks. Do you also not see, let's say, geopolitical and macroeconomics to be a huge impact, especially in these emerging markets, that perhaps, to an investor like you or your investors may even, I'm just trying to not even play devil's advocate. I'm just I'm more curious about what the motivations are to invest in a market like this, because I'm also putting myself in the listener's shoes and trying to understand what is the investor understanding of these markets or the motivations that really get them excited to be investing when we are getting to see all of the things that's in the news right now, hey, China has got all of these issues with the United States. Of course, India is now as we're recording it, on the brink of what could perhaps be some sort of a war with Pakistan, and then you have, tensions that are obviously cropping up every other day with Latin America in their own. There's civil unrest happening in certain countries. So as an investor, does that not spook you to an extent, or does it still excite you that, hey, I know you as an investor invest in internet companies, but if you were to just take a macro lens and just look at the landscape as such, how do you think about that?
Well, look, the world's a risky place, and the riskiest place are the emerging markets.
Right.
And there's no free lunch there. And so geopolitical risks are obviously important. China is, it's first of all, and importantly, it's by far the biggest emerging market, and it's the most important emerging market. And it's from the day I got involved 20 years ago, it's been something that people were worried about and concerned about. They're communist, and whatever other stereotypes they have. But that's a big risk. Just look at Russia. We had, I think, 6 Russian internet holdings that overnight became worthless. Yeah, and some of them were brand new, fresh IPOs that had great growth and great margins, and just like that. So yes, you don't have to look far to see those geopolitical risks.
But even before we head into having a deeper discussion around this, maybe what would be nice to even define to our listeners would be, what do you classify as an emerging market?
Well,
because you just talked about China saying it's still the biggest emerging market, and the reason I'm bringing this question up is because a lot of our listeners are exposed to this kind of narrative, especially within the Indian ecosystem, where they say India has arrived. India is no longer an emerging market. We have emerged at the world stage. And you just said China is still an emerging market. And China has already arrived 2 decades earlier. So what is the definition of arrived, or what's the definition of emerging?
Okay, no. Good and important question. So for all intents and purposes, the definition of an emerging market is what MSCI says it is.
Right.
Okay, because that's the benchmark that all the institutions use. MSCI invented the index, right? They created, it's a great story how it happened, basically. I mean, the World Bank, the IFC, wanted to create an index to track third world countries so that institutions could help stimulate these places and their growth, but they wanted to create an index of third world countries. And they met with a very large investment manager in LA called the Capital Group, who had actually invented the EFA index, which is the Developed International Index. And they said, hey, can you make an index of third world country stocks? And they said, well, we'll take a look. And they sent a couple analysts to go figure out if they could find enough companies in third world countries. And they got back together a couple weeks later, and the analysts said, yeah, there's enough companies. There's a state-owned oil company here, there's a state-owned electricity company there's a brewery in the Philippines, there's Walmart in Mexico, but nobody's going to invest in third world countries. You need to change the name.
Right.
And so they decided they would change the name and call them emerging markets. So they're the people that created the index. That's the way the world looks at the investment world is what's in the MSCI index. And again, there's about 25 countries, the biggest being China, biggest by population, China, India, Brazil. And then there's another 20 or 25 countries that are called frontier markets.
Right.
And now those are supposed to be the pre-emerging markets. And the main way that these things are defined is what's the per capita income? Or what's the per capita GDP? And to be a developed country, that number has to be about $25,000 a year.
Right.
So the average person needs to be making about $25,000 a year. China's at 12,000. They have hundreds of millions of people that are developed, but they've also got 500 million people still in the countryside making $3,000 a year. So collectively, so now, even when I got involved 20 years ago, people said, well, should China be its own allocation? Should it be an emerging market? Well, that's not up to me. I mean, ultimately, if you follow the money, it's going to be tracked to the MSCI index. Right. And so that's essentially what it comes down to. If your income is, say, average income is 5,000 to 25,000, you're emerging. And if your average income is below that, you're frontier. And if your income is above that, you're developed. And I'll give you a case in point, Korea. According to MSCI, Korea is still an emerging market. Now, the Vanguard fund, the Vanguard Emerging Market ETF and mutual funds, they track the FTSE index. FTSE says Korea is developed. And so that's the main difference between the two different emerging market indexes is one says Korea is developed, one says it isn't. Almost everybody agrees that Korea is developed except for MSCI.
Right.
And I think the reason they don't agree is because when they promote it, there's so much money tied to these indexes, right? That moving it from one bucket to another and the trillions of dollars that are benchmarked to this, it may not be easy. And so every year they kind of act like they're going to promote Korea, but then they find a technical reason why they should wait another year. But eventually Korea will get promoted up to into a developed
market. No, thank you for providing a little bit more context around that. I think that makes it easy for some of our listeners to understand what's going to be following up here in our discussion. I wanted to focus this second segment on understanding more about India, because that's been the theme of the podcast, and that's one of the things that you've been actively spending a lot of your time as well. You're in the country, you're obviously on ground, you're getting a pulse of what's happening within the Indian ecosystem. You're obviously investing in the country through your fund. So let's go back to when India became exciting for you personally. I'm leaving out the numbers, I'm leaving out the internet story, I'm leaving out all of that. When did India as an economy become interesting to you? And you start feeling that, hey, this is where it's not just about what the next 5-10 years is going to look like. It's the next 50-100 year story that we're perhaps looking at, and maybe this is the next China that's waiting to happen. When did that shift happen for you personally?
Sure. Well, I first got involved with emerging markets 20 years ago.
Right.
Basically, it was at Google. My business partner, Bert Malkiel, gave a talk to the Google at the Google campus about investing in China. I was working with a lot of the early Google engineers and helping them with their portfolios. And they asked if Bert could come talk about China. Now, I didn't know anything about China, really. I mean, other than what I read in the books and seen on TV or whatever. But he had gone and written this book about investing in China. And so I said, all right, well, Burton can come down and talk about China. And then when he was done with his talk, all these people at Google looked at me and said, we want to invest in China. And I was like, well, I have no idea what that means. So now, at the time, it was clear to Burton and pretty compelling that China was on the rise and that they were embracing capitalism. The economy was growing 12 or 13%. And so that's how I first got involved. And I, very quickly realized that you want to focus on the consumer story. And but then about 11 years ago, I got a call when I was in my car, and I answered it on my smartphone, and someone said, what's the best emerging markets ETF? And that's when I realized that it wasn't the traditional consumer companies anymore, not the food and clothing companies. It was the Alibabas and Tencents. It was the technology companies. They were the new consumer companies. And so when I launched 11 years ago, our main fund, EMQQ, it was 65% China and 1% India, because there was only 2 Indian internet companies. And I had spent a lot of time in China in the decade before I launched EMQQ, and I knew what was going on there, and they had a pretty still had a long way to go, but the internet opportunities seemed pretty big. So, but we only had 1% in India on the first day, 10.5 years ago. We owned Make My Trip and InfoEdge.
Right.
And I knew about those 2 companies, but I had never been to India at that point, and it didn't seem likely there would be any Indian internet companies anytime soon. And so for 7 years, we waited for India. We knew there was a lot of unicorns. We certainly knew about Flipkart and those things, but there just wasn't anything for us to invest in.
Right.
And I had a placeholder slide. The first, in my India section, it was coming soon.
Yeah.
And I had a picture of Modi, and then I had the logos for Aadhaar and the UPI at the bottom of that slide. And I'd say, well, we don't really have any holdings yet, but it's the world's biggest democracy, and there's a lot of entrepreneurs there. And eventually, some of these companies will go public. And then, starting in 2020, there was about 24 Indian internet IPOs, and also an Indian internet bubble that burst that November. But when I saw the IPOs were coming, I decided to make my first trip to India. I knew India was become a much bigger part of my life going forward, and I wanted to go. I had never been there. And so I was scheduled to go to India in April of 2020. And then COVID came. It didn't stop the IPOs.
Yeah.
And all of a sudden we had 20 holdings, and India had become about 20% of our main strip portfolio. And then we launched INQQ, which is our main focus right now, which is the Indian new age tech sector. And it was before, it was in 2019, 2020 that I started to roll up my sleeves on India and try to get my arms around what was going on there. And it was then that I realized what was going on with this stack. And I had the logos, the Aadhaar, the UPI logos, but I didn't really pay attention to these things. So again, we just didn't have anything to invest in. And so we were waiting, and all of a sudden there was all these IPOs. So, but I've, it was when the IPOs came that that's when it first was real to me, because I could actually invest
Yeah.
And I have devoted almost all of the last 4.5 years to the India story and spent a decent amount of time on the ground and as I've said to many people, I mean, India is the perfect emerging market. It can't really happen again. I mean, the India story is, if you're an emerging market investor, which I have been for, if you're an emerging market investor like I've been for the last 20 years and will be for the next 20 years, it can't get any better than this. I mean, on paper it's perfect, and then you add in some of the other key parts like the stack, and I think is just it's an opportunity unlike any other that has come before. China was, again, a big opportunity and had massive growth, but it always had the kind of China asterisk next to it.
There are a couple of follow-up questions that I have there. One is, you talked about how the India story is like the perfect story, and also at the same time, you were on ground, you rolled up your sleeve, you were trying to learn more about the market. So as an outsider looking in, India is a very different market. And when you start putting money against it, India, obviously the story and the face changes. So I want you to explain to our listeners, and me too, I'm also curious about this. How does a market, maybe we'll take India just so that it's easier for everybody to like relate to and understand. When you look at an emerging market from the outside, there are things that excite you about it, and then when you start putting money against it, realities come to the foreground. Talk us through that about India. What seemed like shiny gold from a distance, and what were the realities when you actually start putting where your money is?
Well, I had spent a lot of time, analyzing the situation before I went for the first time 3 years ago. And when I got back, I was like, what am I missing? Like, this is too good to be true. And I remember, because look, on paper, it's not really disputable that India is perfect. Because if you look at, why do public market investors invest in emerging markets? It's because of the following 4 reasons. They have a lot of people. They have better demographics. Obviously they're younger. They have faster growth, and that's driving consumption. And it's the rise of the emerging market consumer. That's the whole story. The thing that's emerging are those 6.5 billion people. And in every one of those categories, India isn't just number one, it's number one ever, and it can't happen again. If you leave out China, India is bigger than every other emerging markets. Right? Combined in terms of population.
Yeah.
So when an investor says to me, I'm interested in Mexico or Vietnam looks good, I'm like, well, they're cute, but they're good, they're fantastic, and we invest in those places, but the scale of India is on another level, and it can't happen again.
Yeah.
There isn't going to be another 1.5 billion population in any of our lifetimes. Mm-hmm. So it's the biggest. The demographics are well known. The average age of less than 30. It's got the fastest GDP growth. It's fluctuated a little bit in the last year, but call it 6.5%. But I think, as many others do, it can grow faster and probably should. And that's driving consumption, just like we saw in China in the last 20 years. So on paper, India is as good as it gets. And now, when we launched INQQ, it was in April of 2022, when the Indian internet stocks were basically in free fall.
Yeah.
Which I basically peaked with Paytm's IPO.
Yeah.
But the whole sector dropped, 75%. So, and that happens. I mean, we've had 50% declines in all of our strategies, and multiple times. But one of the things that was the most interesting, one of the more interesting parts on my first trip, I gave talks for the CFA Society in Delhi and in Bangalore and in Mumbai, and it's fun to give a talk about emerging markets in an emerging market because you get to you got to make sure you bring you've got your stuff together.
It's like teaching a chef how to cook.
Yeah, exactly. But in every one of those presentations, at the very end, the first question was, why in the world would I invest in Indian internet stocks? They're a terrible investment because they had basically all gone down.
Yeah.
And I would say to them, I'd say, well, you're 26 years old, so you've got a long time frame, and you can buy twice, 3 times as many shares, and you should be a long-term investor. But so the Indian market is, as you touched on earlier, I mean, there's 180 million brokerage accounts, but 150 million of those were opened in the last 8 years, and the market never went down, the Nifty 50. So they just lack experience. Even people that have experience still don't have, understand maybe what they're doing so much. But so everyone said, well, no, Indian internet stocks are a terrible investment. U.S. internet stocks, those are good, but ours are bad. And then they would say, none of them know how to make any money. They're all young and they don't have any experience, and they're just burning venture capital. And I think basically everybody read Big Billion Startup, or at least all of the things about Flipkart's journey, the ups and downs, and maybe the downs. People they built this. This is the Indian, CFA groups I was talking to. They all were basically like, no, these internet companies are down and out, and they're no good for investing. And when I got back, I actually looked at our portfolio, and there was only 3 companies that weren't profitable.
Yeah.
Right. And one of them was Zomato, which turned profitable right the next quarter, I think. So India, I mean, it's a huge opportunity, and it's very early, and people are, U.S. and global investors. It's very abstract to them.
Yeah.
And as I mentioned earlier, I think 95% of the professional investors that I speak to in Europe and the United States, they've never been to China or India, right? And it's hard to have any sense of a place if you haven't actually been on the ground there. And in the case of India, unfortunately, neither of India or China China's got its own problems with communism and slave labor making my shoes, or all of these crazy things that Americans have in their heads. But India's got a different issue. It's looked at more favorably because it's democratic, but it's still very abstract to people, and most of them they just their only exposure is maybe they saw a movie about India,
as we were discussing.
Yes, right? I mean it's unfortunate, but quite literally, I mean, I think that Slumdog Millionaire is probably half of what Americans know about India. Is whatever they think they learned in that movie.
Yeah, I completely agree with you. I think I tell this to people all the time. I think what a lot of people who look at India, they probably know 3 things. They know Slumdog Millionaire, they know Bollywood, they know cricket. And that's the only thing that I get from most people who I speak with who remotely try to make conversation about India. And the other thing is probably I love Indian food. That's the other thing that people get thrown about, but they don't really understand India deeply. And we were discussing that previously as well. And you brought up a couple of really interesting points there, which is the internet stocks being down, especially in 2022, and it's slowly growing back up. And how a conservative, I don't know if I'll get a lot of flack for this, but the CFA community has been a little bit conservative. They've looked at public markets. India in general, if you take a look at it, and public market investors have largely been conservative investors. And this is not just me talking, this is when you take a look, you just see the history of Indian retail investors. Largely they've been a good percentage being conservative investors. So I'm not surprised that people are skeptical about what the internet stock industry, internet stocks look like, and what the industry is going to look for the next 20 years, even though we all believe that the next 2 decades, 3 decades, 5 decades are going to be the age of the internet. The internet's not going away, we all know that. And anybody who's questioning whether there's going to be growth is probably still living and thinking like a dinosaur. The only thing, or I think the subtext there, and they ask is it the right time to invest in these internet companies? I think what they're trying to like say or think about there is, are these companies running efficiently? Can these companies run better? When are they going to turn profit? When is it the right time for me to invest? I don't think they're saying I will never invest in internet companies. It's about finding the right time to be investing in these companies. And those are the things that I think the Indian market is still trying to learn a bit. Governance is something that we're still learning. We still have to get into place this whole mentality of, like you said, it's not just about burning VC money. VC money is there, it's good. We all know there's a reason, place. Many companies take time before they turn profitable. It's how and when are you thinking about profitability? And I think we went a little too far overboard when we got that conversation going. Now, that conversation about returning profitability trickled down so far that pre-seed stage and seed stage companies were getting asked to think about profitability from day one. So India is kind of notorious for taking it to the extremes. We think of, when you're talking about profitability, it's great. It's good for public companies to think about it, or soon to be public companies to be thinking about it. But then to push that narrative all the way down to a seed stage company is not the way to think about it. Even though I get what they're trying to do, is they're trying to get people to be a little bit more efficient, because that's how you kind of like build up the backbone of the startup industry, which hopefully is going to be the feeder fort for the public markets at some point of time in the next 5, 10, 15, 20 years or so. So having said that as the context for the question that I have, how is India different from other emerging markets in terms of performance? Or the internet market different from the internet markets that played out in China, which you were obviously a big part of? You saw that grow in the 90s and the 2000s. You're seeing Brazil and to an extent maybe Southeast Asian markets in the 2010s. And comparing that to the last 8 years. I was about to say 5 to 8 years, so roughly about pre-COVID as well. Last 8 years or so, how India has performed on the internet spectrum, especially when it comes to the stock market.
Well, as regards the stock market for the Indian internet stocks, I mean, again, Make My Trip and InfoEdge, where I've been public for a long time, and they've done quite well.
Yeah,
very, very well over the long term. And one of the most important things for any investment in public equities, you need to be long term. You need, especially in emerging markets, you need to be 10 years, 20 years, because the miracle of compounding is the most important part. And it's so early, in my opinion, in India that again, valuations always matter. You want to pay as little as possible, but there is such a huge growth opportunity, not just in the next 5 years, but in the next 10 and 20 years. And if you look at whether it's travel or food delivery or whatever, these subsectors can grow 300, 500%, and it will still be early. And so that's hugely important. Now, in terms of performance of the stocks, it's been terrible. Again, when we launched the Indian internet stocks, the new age tech companies were already crashing. And even though we launched 6 months after the top, we still had a 50% decline in INQQ.
Right.
And we're not even back to the price we launched it. When we launched INQQ at $16 a share, it went down to 9 or 8 or something. We got back to 17 in the December, so it took almost 3 years to get all the way back to where we started.
Yeah.
And then, of course, there was a sell-off in the fourth quarter, and we're still down below where we launched 3 years ago.
Right.
So now, all of the emerging market internet companies had a correction. It wasn't just India. China had, because you had the macro backdrop, which was interest rates went from 0 to 5%, which is going to crush multiples for any growth companies. But then China also had the trade war and Jack Ma's missing and all this misunderstood stuff. So it wasn't just India's internet stocks that went down, but I would say that the Indian new age tech companies so far, which is in terms of our index, it's 3 years are down. But it's so early, and as you pointed out, that there was a lot of froth in the internet private markets in 2020 and 2021, and there were billion-dollar rounds happening. The quick commerce company we talked about earlier in Bogota, Rappi, had raised $1 billion round from SoftBank, and so it was a good, healthy thing for them for the money to get harder and for discipline to be pushed into the system. And you saw, a lot of companies that went away, but you also saw a lot of companies that tightened up the belt. Maybe, a lot of examples of it, but basically, ultimately, you're going to have to make profits.
Yeah.
That's what it has value. You can get acquired by somebody else before you make profits, but that's only because they think they're going to make profits. And so having a focus on that early is good, but I don't, I did a CNBC Singapore piece right after Zomato reported, whenever a month or two ago, and they said, well, what about they missed their earnings estimate? I'm like, if you're worried about the short-term earnings, like you don't want anybody involved. You certainly don't want the management team worried about reporting, what the pennies are going to be when you have these, multiple $10 billion plus opportunities to go after.
Yeah.
And of course, everyone knows that, Amazon didn't make a profit for 20 years.
Right.
And they lost money, including some of my money in 1998 when I was shorting the stock as a cocky value investor. So profits long-term important, a path there important, but the venture acceptance of loss making, it's going to change.
Yeah.
When money's tight, it's going to be a higher bar, which is healthy.
What do you think that the Indian retail investors don't really understand about the internet stocks?
Well, I want to, again, there's 180 million, DMAT accounts, and 150 million of those are open in the last 10 years, and the Nifty 50 went up every one of those years. So they don't have a lot of experience.
They're restless.
They don't, one of my favorite sayings, good judgment comes from experience, and experience comes from bad judgment. And I know, when I was in India for the month of November, there were already signs of froth in the market. I mean, the options trading alone was a red flag, serious red flag. Although you can't really have a bubble in that, right? You definitely, it's a sign of speculation, but it's just gambling. But in the small mid cap, there was kind of a Wolf of Wall Street pump and dump kind of thing going on, I think, in the shadows. And but there were two conversations I had with people that they were just regular people. They weren't stock professional investors, and two of them said to me, it was almost out of the book. It was one person said, well, I was going to open a boutique with my friend, but I'm just going to trade the shares market for my job. And another person told me that they'd been getting up early in the morning to do research to start trading stocks.
Yeah.
And that's a bad sign also. The right mentality is to buy and hold and just keep buying and holding. But I can't change this, and it's not going to change. But if you think you're going to trade or look at charts and do research and beat the market or make money, then you're fooling yourself.
You're a day trader, at best.
You are, yes, and it's not just retail investors, and it's not just India. I mean, this is unfortunately still the predominant thing that individuals do. But if you really understand this, the way to get rich, at first you got to invest. So you got to make more money than you're spending, and then you just want to keep buying things and buy the right things and let the miracle of compounding take care of itself. And so, there's no sector in the world right now, when I look to the next 10, 20 years, I don't think there's any sector that, in terms of public equities, that's going to grow as much as the Indian internet sector. And even if you bought at the top in November of 2021, I think you'll still end up with a very, very satisfactory return in 10 years or 20 years. And even though there was a 75% decline, remember Amazon went down 90% at one point. And so if you had bought in the top of Amazon in 2020 or in the year 2000, even though it looked,
you'd be rich.
You would be
Beyond
rich.
rich.
Right. And so the miracle of compounding can take care of a lot of timing issues. So what I strongly suggest to any person that has a 10 or 20 year time frame, which hopefully most people do. Certainly, anyone in their 20s or 30s, you want to buy and hold the new age India tech sector, I think. And I don't know. I mean, there's all of emerging markets. Internet companies are the way. I think no matter which country, the internet companies. I think are the way to go if you're a long-term investor, and I don't think there's any place that has the opportunity that India has.
Let's double down there a little bit more, because you talk about the opportunities for the next 5 to 20 years, and yes, whoever's listening who's between the ages of like 18 to like 35, which is largely the audience that listens to the podcast, will be looking at long-term investing, and hopefully not just short-term, like 2 to 3 years. And that, in which case, probably internet's not the right place for them to be looking into for investing for the next 2 to 3 years. It's probably a different game that they want to play. Now, within, let's say, 20-year investing, you're looking at the internet stocks. What within that is exciting? Because there's media, there's finance or there's fintech, there's e-commerce / marketplaces, there's retail. So what are you excited about within that, specifically within the Indian market?
Well, almost in every direction you look, it's early. I mean, the one company that I feature, talk about the most, one of our biggest holdings is Zomato, now Eternal. As you know, they changed the name just recently. I still can't get my quotes to come up right on it. It's still getting an NA. But I think that Eternal is just a great example of the opportunity that exists in India. I mean, you've got again. I talk to a lot of investors, and so I'll say, well, Zomato is like DoorDash. It's the DoorDash of India, and it's true. It's the leading food delivery company. But it's not really true, because when DoorDash arrived in the United States, we had a very well-developed restaurant industry. We had plenty of restaurants. The restaurant supply business was very competitive. So, but in India, everything's kind of a green fields opportunity or a white space opportunity, and the entire restaurant industry is early and still sort of informal, if you will. And so Hyperpure as an example, if they can also have that business as an opportunity, which is a massive opportunity. And the Blinkit and Quick Commerce is, the reason they're changing the name of the company, presumably, is because all of a sudden Blinkit's going to be the biggest part of the company, not Zomato. So that's, and if you look at the per capita spending on food and groceries online is like $10 a year. China, it's like $230 a year. So you could triple or quadruple the size of that, and you'd still have a long way to go. So I think Zomato is Eternal, a great example. And so the future of eating food, right? I mean, it doesn't get much simpler than that, right?
It's a necessity.
It's what if
not going to go away.
As Warren Buffett says, when he invested in Gillette, he said, I know that every night there's 3 billion beards growing, and every morning there's 1.5 billion people that are going to get up and hopefully have 3 meals or eat themselves. So, you have Nika, online beauty products. The per capita spending in India is so small that they could grow the Indian, that sector in India could grow 300 or 400%, and it would still be halfway to where Thailand is per capita. So in almost every direction, you have these incredible growth opportunities. But the most intriguing thing to me in India right now, and I think probably the single greatest commercial battle on the planet today, is quick commerce in India, and so that's my personal favorite part of this long-term opportunity, because that is a massive opportunity.
And that's looking into the future, right? Because Zepto is not going public, maybe in the next couple of years or so, but not immediately. So you're still looking into the future and saying that's going to be where big. But how many such players will you see emerging in the market? Zepto is the only opportunity that is very evident for a lot of people to see in the next few years.
I mean, we own Zomato, or we own Eternal, which Blinkit's got, at least 50% of the market, so they're the leader.
Yeah.
Swiggy, Instamart, Swiggy went public when I was in India, actually, so we own that as well. And Zepto is the only pure play, at least the scaled pure play. And actually, they may end up going public this year, at least from what I've seen in the media. But eventually, whenever they see the time to do it, they'll do it. And it's so early in this. I mean, it's green. You're talking about green fields. I mean, there are whole cities that they can go to that's not even competition yet. So, and I, as I said, India is the perfect emerging market in one category, but it's definitely the perfect emerging market for quick commerce, I think. And when you look at the size of the Kirana store market is 550 billion a year and 13 million. I mean, it's as fragmented as you're going to get.
Right.
And one of the other things that is, I think, exciting about quick commerce is, the average Kirana store has about 200 items, and the quick commerce guys have thousands of items. So it's not all about taking market share from that 550 billion. Right, because ambulance service isn't available at the Kirana store like it is at Blinkit, for example. That's just one example. But there's when you see businesses go in directions that you would have never thought. Right, I'm going to have a document printed and brought to me in 10 minutes. Right, I'm going to have 10-minute private ambulance. When you see businesses going in directions like that and having it work, that is also, I think, just a strong sign about the disruptives. Obviously used a lot, but it's creating in just a whole new area that didn't exist before. Services and ways to leverage this quick commerce, or the test drive of a Suzuki in 10 minutes.
Yeah.
Right?
Yeah.
So I'm quite excited about quick commerce.
I love that. So a lot of the India opportunity is going to open up in the next 5, 10, 15 years, as we discussed it. And you today, sitting as an investor, of course, you've got existing stocks on the market that you can play around with. But sitting on the sidelines, other than waiting for some of these public companies to go public, what is it you as an investor can do to push more of these entrepreneurs to start thinking? Or what are different ways that you can really make an impact so that these companies can go public and you get to play a hand when that happens? So what are you and investors like you actively looking to do about shaping the industry?
Well, India has a pretty robust venture capital sector right now, and I think that's only going to continue. I do think there's still a lot of opportunity at the kind of the seed stage. We talked about 2AM, Brendan and Herschel, and those guys have been able to find some great opportunities, and so what we do, I mean, we don't do anything directly. I mean, I'm always a champion for entrepreneurship, and whenever I have a chance to speak to a group, a CFA society, and Bhat or wherever, I'm always eager to meet the aspiring young entrepreneurs and investors and cheer them on. But so far, I mean, we all we can do is wait till they go public, and the venture guys will have to get them there.
To almost play that role of guardianing them all the way to the public markets.
Yeah, well, that's one of the things that when I started my company, and I started EMQQ, our first ETF. I met a guy who he was a former Tiger investor, and when we had an intro meeting, because he had created an emerging markets internet index that he was using to raise his venture fund. And I found his emerging markets internet index. I'm like, oh my gosh, someone else has one of these already. And we met. He was in the Ferry building. And I said, well, we're on the same team. And your goal is to find these entrepreneurs and fund them. And, and when they go public, then we sort of grab the baton, right? And so we're on the same team. So there's nobody that is, a bigger cheerleader for that to happen than myself, because we only have 29 new age tech companies right now from India that we own. And so whenever, like Herschel and Brendan at 2 a.m., I'm like, well, you write the first check, and when these things scale up, hopefully especially your goal and this entrepreneur's goal is to become part of INQQ,
right? Because
that means you made it, right? So, and that's happened actually. The founder of Coupang, one of the first investor in Coupang, which is a Korean e-commerce leader. I met him well before Coupang went public, and we said, well, that day when it happens, I'm going to find you, and so that finally happened. So I'm a cheerleader for the Indian startup community. And I'm a happy long-term buyer when they go public.
I love that, and I've kind of got that from this conversation. I've heard you share that sentiment, saying India is the pot for brewing magic, and it's a recipe for stock market success and the internet stock market success in the next 20 years.
Well, look, I talked about all the basics about the size and the youth, but the thing that there's two other things that India has, right, that set it like on a whole nother level. Because again, if we just look at the basics, the population, the demographics, the growth, it's bigger than all of the other 24 emerging markets. So it's on its own thing. But then you add in the human capital, right? Because look, there's a lot of countries that have young populations, right? Big populations, but none as big as India's. But India's got the human capital that India has. It doesn't just stand alone in emerging markets. It stands alone in the world. I mean, America's got good human capital. China, with its other issues, arguably has pretty good human capital. But there's 25 S&P 500 companies that have Indian CEOs. Right? The CEOs of Google and Microsoft. Right? And it's not just that you've the number of deans of business schools in the United States, the United Nations. I mean, the Indian human capital is on a whole other level. You're not going to find that in Vietnam or Mexico or any other, even name a developed country other than the United States that has 25 S&P 500 CEOs. There is none. Mm-hmm. So, and you have the IITs and the IIMs, which are world class. So, and the other thing is that, and I told you I listened to the Snapdeal interview you had, and he talked about this. That 10, 15 years ago, entrepreneurship wasn't like a thing. But the number of startups in India now is, it's up 250x in 7 years.
Yeah.
And so you've taken this incredibly rich talent pool that historically has, a lot of it is left, and now they want to start their own companies. And you have it's also spreading to second and third tier. Almost all of the holdings we have now, the founders did go to IIT Delhi or IIM Ahmedabad or some other II in India. But now I think everything's spreading, right? There's 240,000 startups. Obviously, the vast majority of them didn't go to one of the IITs. So the human capital and it's just now in the last few years really starting to become more entrepreneurial, and that's hugely important because entrepreneurs create jobs.
That's right.
As well. So that's one of the risks to India is it needs jobs.
Yeah.
And then the other thing that sets India above all of the other emerging markets and all of the developed markets is the India stack. I mean, the world does not understand or appreciate what the India stack is and how incredibly valuable this is. I mean, I am absolutely convinced this is a secret weapon. And I talk to thousands of investors, and when I'm in a live audience setting, I will ask people, how many of you know what the India stack is? And never once has somebody, now every now and then someone that's heard me talk before, or someone, if I'm doing this at IIM Ahmedabad, obviously I don't ask the question, but if I'm in, Geneva or Milan or whatever, I'll ask the question. No one's ever raised their hand. And then I even ask them, do you know what digital public infrastructure is? They'll say, I don't know what that is.
Yeah.
So I am convinced that the stack is an asset that's worth $1 trillion or more and growing. And I don't think the world quite appreciates what it is and what it does and what it will continue to do and what it can, what it's becoming.
I love that. It's music to my ears and hopefully all of the listeners as well. We're all as excited about the India story as much as you are. And hopefully the next 10, 15 years turn out to be the most glorious years for the internet India stocks. Now, as a parting note, I wanted to ask you this question. I typically ask a lot of the guests on the show about some of the learnings that they've had and things that the kind of advisor, things that they would tell themselves if they were starting out earlier. And I'm going to pose a very similar question to you, but with respect to the Indian stock market or the internet stocks that you've been talking about for the last hour or so, very generously here on the show. Two questions. One, a piece of advice that you would give yourself if you were starting out today as an Indian investor looking into the Indian internet stocks. And the second question is, what's been the one biggest learning that you've had after knowing everything that you know about the Indian market?
Well, the advice I would give to any investor and any young investor, and since the average age in India is 28 and a half, then I guess the average investor is definitely young. It's the same advice I'd give to an American or French or any investor is you need to start investing. You need to start buying. You need to save money every month. And there's a lot of places you can invest it, but the stock markets have been, particularly in India and the United States, have been very good, relatively stable, long-term places to put your money. So first and foremost, buy and hold, buy and hold, buy and hold. Just keep buying. Don't sell. All right. If you sell if you bought the wrong thing, but whatever you buy to replace it, your goal is to never sell it, because the miracle of compounding is hugely, hugely important. You're not going to day trade yourself into being rich, but you can definitely buy and hold yourself into being rich or very rich. In terms of what you want to buy things that are going to grow their earnings, because that's what makes companies value, is the profits. And it's easy. And again, as I mentioned, I was shorting Amazon in 1998. It's easy to be this idealistic value. there's always naysayers. And I was a naysayer. I mean, I was telling other people to short Amazon, and it had a market cap of $1 billion. Growth is important, and so for the average investor, and obviously this I'm biased and I am conflicted because it's what I have a product that allows people to do this, but buying and holding the Indian New Age tech sector, the Indian internet sector, I don't know of a better thing to buy and hold for the next 20 years. There may be other things that will do better, but I don't know of them. And so whatever you're going to buy, just buy it and hold it, whether it's the S&P, whether it's Eternal or Make My Trip or whatever it is. Just don't overthink it. Just buy it and hold it, and then try to make more money and buy more assets and hold them as long as you can. And that's the way to do it and make the most money long term.
Great, thank you for that. And the last question was, what have you learned about yourself, or about just one thing you learned about yourself investing in India?
Well, I don't know. I mean, I've learned a lot about. I don't know yet. I think the one thing that I would say is that I've learned a lot about India. Yeah. I've learned a lot about India's history, which is fascinating, and I went very deep. When I 4 years ago or 5 years ago, when I started getting ready to go, I'd be up till 2 a.m. and I'd be down a rabbit hole, and I'd be reading about the Battle of Plassey and Mir Jafar and all sorts of interesting parts of India's history that I learned. I guess one of the things that I've learned, and I certainly saw this on my trip this last November, is, and actually in the episode I listened to on my way here, the Indians are incredibly patriotic, right? When you talk about, I'm starting a company to help give back to India. What can I do for the country? How can I help advance the country? That's awesome, and I don't think there's any startups in the United States that say, "Well, I'm doing this to help advance my country." I'm sure there are some, and maybe certain business models, lend themselves to that approach, but I was just, and I continue to be so amazed at the patriotism and the wanting to give back and serve the country. And friends that I have that worked for Goldman Sachs for 10 years, and then they went to work for the government, for the National Innovation Foundation, for example. Mm-hmm. So that's a thing about India that I've learned that is, it's important and it's good. I mean, it's to be admired, and I think it's another reason why I'm so bullish on India, because it's got the best human capital, and it's the human capital that's concerned about advancing the country. So I guess that's my answer.
I love that. And that's a great note to end the episode on. It's such a high, because you did talk about, the India opportunity, but towards the end, we really talked about what is really making that opportunity tick, and what is going to make that opportunity tick and last and win in the next decades to come. So I couldn't think of a better note to end the episode here. Thank you so much for being on the show, Kevin. It's been a pleasure. I've learned a lot about not just you, but also why you're bullish on India, because every investor, when I speak to them, they go long on India, but they have their own personal reasons, backed in data, of course, but there are reasons why India really is appealing to them. And I got a chance to like sit down with you and learn about what's really important for you, for your fund, and why you're really playing the long game here, and how you're backing and will be backing some exciting companies in the years to come. So thank you for everything that you're doing, and hopefully I will bring you back on in the years to come, maybe next year or a year after that, and we'll really talk about what's changed in the period from now to then, and see how far the country, how far the economy, and how far the internet industry has grown. And hopefully we'll have a couple of other exits to talk about, other companies that have gone public, and some success stories. And hopefully your investments from the last 3 years, from 2022 to now, are also taken up, and we can really talk about with the learnings that you've had from that curve there as well.
That would be great. I'll look forward to it.
Thank you so much.
Thank you.